This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Wednesday, August 5, 2026, and this is the Tokyo session. Now, let's get into it. The market is locked in a vice grip of fear. The Fear and Greed Index has plunged to an extreme 14 over 100, yet the VIX remains eerily suppressed at 15.86, creating a dangerous disconnect between spot panic and derivatives complacency. Safe haven demand is surging, pushing gold to 4,131.9, while the US dollar maintains its grip on the yen at 157.42, hovering near critical intervention thresholds. We are live as of 1918 ET on this Wednesday, August 5, 2026 session. Before we dive into the cross-currents, let's look at the calendar. The single biggest catalyst for the Asian session is the Bank of England's rate decision tomorrow, August 6, at 12:00 UTC. This isn't just a UK event. With cable sitting at 1.34567, any deviation from expected hawkishness will ripple instantly through sterling, yen, and euro sterling. On the other side of the pond, we also have the Reserve Bank of Australia's decision coming up on August 11, which could test the resilience of Aussie dollar, currently trading at 0.705. And looking at macro headlines, we're processing reports that the Trump administration is refunding $100 billion in struck-down tariffs, a move that could subtly alter trade flow dynamics. Alongside BOF, a CEO Moynihan forecasting 3 additional Fed rate hikes through year-end 2026. Here is the snapshot. The dominant theme is risk-off. Gold is up 1.44% to 4,131.9, testing its 5-day high of 4,136.67. Dollar-yen is down 0.18% to 157.42, retracing slightly from its 5-day high of 160.883, but still elevated. Aussie dollar is holding its ground at 0.705, up 0.5%, defying the broader fear. Meanwhile, dollar Swiss is weakening to 0.807775, down 0.17%, highlighting a divergence in safe haven flows. Let's bring in Pulse to unpack this sentiment anomaly. It's a textbook divergence. You have the Fear and Greed Index screaming extreme fear at 14 over 100, driven by investors pulling back from risk assets. But the VIX, it's languishing at 15.86. Barely moving. That tells me options markets are completely asleep at the wheel. They aren't pricing in the shock that the spot market is clearly bracing for. And look at the macro drivers. With CPI stuck at 3.46% and core PCE at 3.29%, far above the 2% target, the Fed has zero room to cut. BOF is calling for 3 more hikes. That structural inflation pressure keeps the dollar bid firm and crushes any dovish hope for the yen or euro right now.
A Pulse, you're letting the macro drown out the immediate technical reality. Price is at 157.42. That is nearly 800 pips away from the 149 intervention floor you might be fixated on. What matters right now is the 5-day high of 160.883. Dollar-yen has rejected this level repeatedly since late July. It is a hard ceiling. Similarly in gold, we are at 4,131.9, practically touching the 4,136.67 high. That is exhaustion. There is no room for error here. The market is trapped in a consolidation box across the board. Euro-dollar is sandwiched between 1.14552 and 1.1559, and cable is coiling at 1.34567. We are not breaking out, we are coiling.
And grid, that coiling is built on a powder keg of positioning. You see resistance, I see a liquidity trap. Look at the latest CFTC data. Leveraged funds have dumped a staggering plus 103,259 net long yen contracts into the market this week alone. That is an insane crowding of the trade. The moment dollar-yen decides to turn, that volume doesn't fade, it collapses. Conversely, look at the Aussie dollar. Despite the fearful sentiment, Aussie dollar is holding near 0.705, because leveraged funds are long plus 27,618 net contracts. Smart money is rotating into RC specifically, ignoring the broad risk-off noise. The Canadian dollar is getting crushed with 102,495 net short contracts, making it the weakest G10 currency. This isn't just sentiment. It's structural flow divergence.
Which brings us to the elephant in the room, the VIX at 15.86, SPECTER here. Everyone is talking about the yen longs and the gold highs, but the real risk is that silence. The VIX is suppressing volatility while the fear and greed index is hitting the floor. That gap is where the blow-up happens. Plus, look at the yield curve. The 10-year, 2-year spread is flattened at just plus 0.45 pp. Historically, a flat curve precedes volatility expansion, not contraction. So you have a safe volatility metric masking a dangerous spot market. If dollar-yen touches 160.88, it won't just bounce gently. The combination of crowded shorts and flat curves suggests a violent gap pricing event.
So we have crowded yen longs, a flat yield curve, and a suppressed VIX. Let's drill down into the specific instruments driving this friction. First, the king of intervention risks, dollar-yen.
Let's map the battlefield. We established that 160.883 is the resistance, but the immediate operational zone is 157.42. The price action from July 31 to August 5 shows a clear descending channel from the highs, but the slope is flattening. This is a consolidation pattern, not a breakdown. The key level to watch for breakdown is the 5-day low of 155.229. As long as we hold above that, the structure is a range-bound defense. Breakdown below 155.229 opens the floodgates. Break above 160.883 requires a fundamental shift, likely intervention.
Grid, you're looking at the chart lines. I'm telling you who's standing behind them. The plus 103,259 surge in yen longs means that sellers are outnumbered by speculators betting on a drop. But wait, let's look closer. The US dollar index itself has seen leveraged funds add plus 4,438 bullish contracts. So who is buying the dip? It's the big institutions loading up on dollar, not necessarily retail yen bulls. The yen longs are likely being squeezed by the dollar's strength, not just stopped out. This creates a short squeeze dynamic where every dip in dollar-yen gets bought by dollar-long funds, propping up the price even as the general sentiment is fearful.
And CIPHER, don't forget the policy divergence. The Fed is hiking. Moynihan cites 3 hikes, while the Bank of Japan is still navigating its own normalization. That differential is the fuel for the dollar-yen fire. The plus 103,259 yen longs are essentially gambling that the Fed pauses. Given the 3.46% CPI, that gamble looks increasingly expensive. The macro engine is pushing the needle up. The technicals are just resisting the acceleration. All right, shifting gears to the ultimate safe haven, gold.
Gold is exhibiting pure momentum exhaustion. We are at 4,131.9, just 0.13% below the 5-day high of 4,136.67. When price trades within such a tight margin of its recent extreme, it indicates that buyers have stepped back. There is no delta left. My read is that we are facing a mean reversion play here. Unless we see a massive volume spike to clear 4,136.67, the path of least resistance is a pullback toward the mid-range of the 5-day channel, roughly 4,080. It's a distribution phase, not an accumulation phase.
Grid is right about the exhaustion, but he's missing the risk trigger. You're treating 4,136.67 as a soft cap. I'm telling you it's a trigger for a cascade. Remember the VIX at 15.86. If gold rejects here, it doesn't mean calm returns. It means the risk-off trade is accelerating. Investors who bought gold earlier are now taking profits into the fear, and new buyers are hesitant. This creates a vacuum. If the VIX snaps back to its mean of 18.21 quickly, gold could wick lower fast. It's a liquidity void above the current price.
But SPECTER, look at the flows. The leveraged funds are plus 4,438 contracts bullish on the DXY, but gold is acting inversely. Why? Because in true stress scenarios, gold decouples from the DXY. The fact that gold is holding 4,131.9 while the DXY is strengthening shows underlying strength. The buy the dip orders are still active. I wouldn't bet on a quick washout yet. The institutional allocation to gold is still expanding as a portfolio hedge, distinct from the speculative yen plays we saw in FX.
Interesting conflict. Grid sees distribution, SPECTER sees a liquidity void, and CIPHER sees institutional hedging. Now, let's look at the outlier in the risk-off environment, Aussie dollar.
Aussie dollar is the odd one out. It's at 0.705, up 0.5%, sitting just 0.0009 below its 5-day high of 0.7059. Technically, this is a break of the lower boundary of its recent consolidation channel. It's testing the upper rail. Usually in a fearful 14/100 environment, risk currencies bleed. The fact that Aussie is holding this level suggests a specific local driver, not just broad flow. Support is firmly at 0.70396. If that holds, we stay in the upper quartile of the 5-day range, 0.69839, 0.7059.
That's because of the positioning I mentioned earlier, plus 27,618 net long contracts. The market is explicitly positioning for a Reserve Bank of Australia surprise or a commodity rebound. Unlike the yen, which is crowded and vulnerable, the Aussie longs are supported by actual commodity fundamentals and the expectation of rate stability. The flow data shows capital rotating into Aussie specifically, bypassing the broader risk-off sentiment. It's a localized bull case amidst global fear.
And don't ignore the timing. We have the Reserve Bank of Australia decision on August 11. Until then, this positioning is front-running the event. The plus 27,618 net longs are a bet on the Reserve Bank of Australia maintaining a stance that is less dovish than the ECB or Bank of England. If the Reserve Bank of Australia comes out hawkish, Aussie dollar could easily tap that 0.7059 high and exceed it. The flow is anticipatory, not reactive. That's why it's holding, while Kiwi dollar, which lacks that specific catalyst, is weaker at 0.587305. Finally, let's touch on the European complex, specifically euro dollar and cable.
Both are in compression. Euro dollar is at 1.1538, effectively pinched between the 5-day low of 1.14552 and high of 1.1559. It's a low volatility squeeze. Cable is at 1.34567, mid-range between 1.34003 and 1.35065. Neither has chosen a direction. They are waiting for the BOE decision tomorrow. Technically, cable needs to clear 1.35065 to signal strength, otherwise it remains range-bound. Euro dollar needs to break 1.1559 to confirm any uptrend. Right now, they are static.
Static is dangerous when the BOE decision is a binary event. If the Bank of England misses expectations, cable can gap away from 1.34567 instantly. The current consolidation is just the eye of the storm. Don't mistake the quiet for stability. The yield curve flatness, plus 0.45 pp, suggests that European rates are also feeling pressure. This compression in euro sterling is likely to expand violently post-decision.
Apex, let's bring it home. How do we synthesize this?
Here is the synthesis. We have a market trying to price in a higher for longer dollar environment, driven by sticky 3.46% CPI and the potential for 3 more Fed hikes. This fundamentally supports dollar yen and gold. However, the execution is messy. Grid correctly identified that dollar yen is hitting a technical wall at 160.883, but CIPHER warned that the plus 103,259 yen longs create a liquidity trap that could cause a violent unwind if that wall cracks. Simultaneously, SPECTER pointed out that the VIX at 15.86 is masking this risk, meaning the move down, if it happens, will be fast and illiquid. Meanwhile, Aussie dollar is bucking the trend thanks to specific flow support, plus 27k net longs, ahead of the Reserve Bank of Australia, making it an isolated strength play. The BOE decision tomorrow is the catalyst that will force pound crosses to choose a side, likely amplifying the volatility that Grid and SPECTER are warning about.
Key takeaways for the Tokyo session. First, monitor dollar yen at 157.42 closely. The 160.883 high is a major resistance, but the crowded yen positioning makes any breakdown risky and volatile. Second, gold is at 4,131.9, testing highs. Expect profit-taking or a sharp reversal if the VIX remains suppressed while spot fear rises. Third, watch the BOE decision tomorrow for pound crosses. It's the most likely source of immediate directional clarity. Stay alert to volatility spikes. This is ShadowQuant Forex edition. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex edition. Stay tuned for the London session, where we will see how these calls play out. Until then, trade safe.